Hi, I'm Frank Masiosi, and I'm here today with David Dietze. David,
Hey,
welcome.
Frank, good to see you.
Great to see you. So this is the October 2025 edition of Summit Financial Perspectives. David, before we start with a myriad of questions that I have, you've had a change in your business.
Absolutely. So I started my business back in 1993, moved to Summit in 95, and we performed wealth management services for close to 30 years. But as time took its toll and tried to figure out, well, how are these clients going to be best helped over the next 30 years, I was fortunate enough to be tapped on the shoulder by PPAC Private Wealth Management, which is a division of the PPAC Gladstone Bank. And we started having discussions. In fact, I had grown up with the head of that operation and realized that their dedication to quality, their perspectives on how money should be managed was very similar. I ended up merging my firm into their firm, worked with them for over 5 years, making sure that there was a very smooth transition. At the start of this year, however, we decided to go our separate ways. Since then, I've been managing family money. I love doing media interviews. I did 2 yesterday and continue to do that. So my clients have a great home with a great institution, and now I'm free to pursue, financial media and other retirement activities now that I have some time.
With that, I can tell by what you've said that you're doing, you're still sharp. So what I'd like to know, broadly speaking, what's your perspective for the next 12 to 24 months? We've had a huge run up, it seems to me. I always feel that, my gosh, it's how can I keep going? But what's your perspective?
Well, basically, we take a very long term on all these things. The one precept I always advise my clients is not to time the market, and 12 to 24 months is very short. Certainly, there's a lot of tailwinds that should give people optimism in the near term, and there's some cautionary factors. I would say some of the tailwinds would be that we're seeing some great earnings by corporations. They've been beating expectations all this year. The earnings season for Q3 has just started in earnest. The big banks have announced great results. We're expecting some great results from the tech companies. We have the prospect of lower interest rates going forward. Lower interest rates is manna from heaven for the economy and for investors. From the economic perspective, it makes it easier for corporations to launch projects. From a consumer perspective, it makes it cheaper to buy a car, to buy a home, because your mortgage rates are going to be lower. And of course, from the investment perspective, every day I urge my clients, what are the potential yields on fixed income? What are the potential returns on stocks, and balance them out? As yields on fixed income come down, then stocks look on the margin a little bit more attractive. You've also got the Trump agenda, and I urge people not to wear their politics on their forearm when they're doing their investing, but some positives that we are expecting is a bit of deregulation, and that can be very good for the financial markets. We're hearing that from the financial institutions. On the other hand, Frank, we've got record valuations that you just noted. It's been almost a bull market for several years now, only punctuated really by the COVID downturn. And as a result, we've got earnings based on next year's expected returns of close to 23 times earnings. We haven't seen that since the dot-com days in the late 90s, and you know how all that worked out. Of course, that's not the only metric for people to be concerned with. You got price to sales. Price to sales is now over 3 times. S&P 500 companies are trading about 3 times in terms of market cap what their expected revenues are. We didn't even see anything that high back in the dot-com era. So we're kind of in uncharted territory. And of course, as we know, the more you pay for an investment, the lower your expected returns. So that's one of the big headwinds that we see that investors have to keep in mind.
Sounds like you're a little bit cautious.
Well, we're all about risk management. And I think job one, of course, is to realize that certain areas of the market, particularly in the global tech behemoths, are trading at record valuations, and it remains to be seen how all that's going to work out. but there's great swaths of the market which have really been left for dead. That could be consumer staples, for example. Who wants consumer staples when you can have sexy AI investments? Energy stocks have not done well. The concern about an energy shortfall when Russia invaded Ukraine has completely dissipated. And so energy prices are very low. I would also look at healthcare. Healthcare is very much under a cloud. There's all sorts of concerns as to how the current administration is handling that. And as a result, I would say that healthcare stocks are trading anywhere from 10 to 20% below what they normally do because of the uncertainties on price controls for drugs in terms of providing for Medicaid and Medicare. And so those are areas that, are worth looking at if valuation is your concern.
Now, you touched on interest rates a minute ago. What about tariffs? What about inflation? What about geopolitical risks? All these things can have a profound effect on the market.
Yeah, absolutely. Well, let's take it one at a time. On the geopolitical risks, of course, if you go back over time, normally if you liquidated your investments during a war or a war risk and then bought in when the doves were released, as it were, you didn't do very well. I always tell my investors, I said, look, as long as the United States doesn't lose a war, don't worry about a war. It's when you lose a war, what happened to, of course, Germany and Japan in World War II, that's not good, although ultimately even their markets came roaring back as America helped rebuild them and they got back on their feet and valuations started from a very low level. We have seen, of course, some developments quite recently that suggest that peace will be returning between Israel and Hamas. We'll see what happens with Ukraine and Russia. But at the end of the day, another test I give to investors is the Friday night, what are we going to do, honey, test. If, notwithstanding gruesome headlines of bombs going off and all sorts of things that are very sad, you're still saying, well, where are we going to have dinner out Friday night? What movie are we going to see? In other words, it's not really affecting domestic spending. That's a good test to say, don't over worry about the geopolitics. Tariffs is a whole other area that we can get into here.
Well, yeah, it almost seems as if there's one person in America that devoutly believes in tariffs and no one else. Obviously, that's an exaggeration. But what are your thoughts?
Well, so, I'm definitely coming from the free market economy school. So tariffs are like a tax. And the higher taxes go, the more sand you're putting into the gears of the economy. And that's a simple truth. There's a lot of different types of taxes out there. Tariffs are one tax. Don't like it. It warps the free flow of international trade. I believe that goods should be made where they're cheapest to do so, and we should trade what we have a competitive advantage in and take advantage of what the other countries may have a competitive advantage in. On the other hand, for political reasons, these tariffs are being thrown around. There's all sorts of myriad objectives that they're throwing around. They want a short-term objective to get a quick regime change, a little bit more help on interdicting drug flow like they did in Colombia. And then in other cases, they have much longer-term objectives trying to encourage companies to invest in the USA versus overseas.
That's the big one, right?
That's the big one. And the reality is, for the most part, that ain't going to happen. I mean, they're not going to bring the manufacture of clothing back to North Carolina. It started in Maine, moved to North Carolina. Now it can be done for 1/10 the cost in Southeast Asia. I don't see how that is going to come back. Okay, I think, for example, they're constructing cars in Mexico where they're making just several dollars an hour versus up to $60 an hour in Detroit. So I just don't see whether those objectives are serious. Another thing that I don't think people are talking about is we have one of the worst budget deficits of all time, particularly given that we're basically in a peacetime situation. And so the United States is desperately looking for ways to increase revenues. So I think that is also on the mind of those who would impose tariffs as a way to impose taxes without getting too much squawk, as opposed to putting it directly on individuals or like a sales tax.
Okay, let's switch gears a little bit. I'd like to talk and get your thoughts about artificial intelligence. And the old adage is, don't invest in what you don't understand. And I wonder how well anybody really understands artificial intelligence. But what do you think about it as an investment opportunity?
Well, I think you have to start with the promise of AI is great. Through high-speed computing, searching through all sources of digital information across the world, you can quickly assemble information which would take you much longer to assemble yourself and to tap into those resources. It can be all put together for you, whether it's an email or a book. So the promise of AI is great. The question, of course, is whether the prices people are now paying and the investments being made will actually turn a profit to justify those prices paid or the investments being made. So, for example, OpenAI, which is a private company and a leader, now recently has a $500 billion market cap based on their latest round of money raising and so forth. But their revenue is measured well less than $1 billion. So that's 500 times sales, not just profits and so forth. Does that make any sense? No, it doesn't, unless you have a very grandiose view of where the AI business is going to go. So, that remains to be seen. Historically, all of these developments, whether you go back to the railroads in the 1800s, take it back to the telecommunications, the advent of the telephone, satellites, the internet, markets have been pushed too high, and there's been a rude reckoning. And so I think that you have to say that at some point, there is going to be a calculation as to, how much have we invested versus what is likely to be produced. And of course, there's going to be competition. China's doing their thing. Middle East wants to do their AI. There's OpenAI, but there's ChatGPT, who's ultimately going to control the business. And so I think investors do need to keep their eyes open that investing in what everyone is talking about may be too expensive to be profitable.
Okay. Again, it's sort of going back to the earlier part of this conversation, sounds a little like a bubble.
Yes, absolutely. And I think that, the fact that they're putting so much money into these data centers and talking about creating their new energy sources, and we still haven't seen really the return on that investment. I mean, all the time, my colleagues come to me and say, "Oh, I got this great answer." And I said, "Well, how much did it cost you to access the AI that you used to develop your paragraph or your email or whatever?" He said, "I didn't pay anything." I said, "Would you pay a lot?" He said, "Probably not. I can just use Google search and pretty much get to the same spot." So that's the cautionary tale.
Yeah. So, how do you figure major economic trends will affect investment allocations? The general thinking is often 60-40 or 60-30-10 equity, debt, cash. It varies. What's your outlook on that?
So, first of all, it's hard to have a one-size-fits-all for all investors. So you can make a great argument that those who are younger, those who are wealthier, those who have longer-term investment aspiration should take advantage of the historically higher returns in more volatile, risky assets, which is generally considered to be stocks. While those who have shorter dated goals, who are not well situated financially, perhaps they have a lot of debt, perhaps they have kids to put through school, perhaps their job is a little shaky, they have some health issues, should have less volatile assets so as to preserve capital and be able to ride out what we saw, for example, in the great financial crisis 2009, what we saw post 9/11 and post the dot-com crash, and they should have a larger percentage in fixed income. So, the general rule of thumb is, take your age and subtract it from 110, and maybe that should be what you have in stocks. But again, for someone who's 95 and has more money they're ever going to possibly use and has all these kids and grandkids and so forth, maybe they should be not using their age, but look at the age of the ultimate beneficiaries of the resources and be more aggressive. Having said that, I do think that given the high valuations and given the prospects for interest rates going down if the Federal Reserve indeed cuts rates, I think that you could use this potential situation to take some chips off the equity table and move it into the fixed income table to reduce risk and still have pretty decent returns.
Very interesting. Very interesting. Could you walk through your core investment philosophy? I mean, growth, value, there are different approaches to investing traditionally.
Yeah, I think the most rational investment approach is to get the most growth you can get in terms of expectations of increased revenues, increased profits, expansion for the least amount of money possible. So you kind of want the best of both worlds. You want the growth, but you don't want to pay so much. So then the question is, where on the spectrum do you fall? Well, I tend to tilt a little bit more towards the value for a couple of reasons. One is that it's very hard to predict the future. So when people say we're not making much money now, but pay more for it because 2, 3, 4, 5 years down the road, we're going to make a whole lot more money. Well, no one has that crystal ball for sure. The problems are that if you have high profit margins, competitors are going to come in. People often overlook other technological developments which will make their business not as attractive. Look at cable TV. Now it's being taken over by streaming and so forth as an example. So I tend to look for situations where I'm getting the most bang for my buck today. So I'm looking for what's the most amount of earnings I can garner for each $1 of investment outlay. What's the greatest dividend can I get for $1 of investment outlay? And so I tend to be on the value side of things. Historically, dividends have been a huge component of investors' returns. Now, just recently, that has not been the case, but there may well come a day, particularly if if the AI boom has a reckoning, or stock investing generally has a reckoning, when people go back to, well, I'm happy to buy stocks which have not done well because I can now get a dividend which is somewhat equal to what I can get in fixed income and so forth. So I've always wanted to make sure that my investments pay some dividends. That also can be a hallmark of a company that's mature, that realizes that profits they make are not always profitably thrown back into newfangled ventures or expansion and stuff like that, that they're sharing some of their success with their current investors and so forth. So I prefer companies that pay a little bit of dividends.
Okay. So a client comes to you and really needs a lot of hand-holding. How do you go about constructing a diversified portfolio for this person?
Yeah, well, so I think it comes down to two things. One is, first, you have to analyze their situation. Where are they in life? What type of employment do they have? What type of other assets do they have? Is their home free and clear, or do they just take out a huge mortgage? Is their spouse working? Where are they in terms of putting their kids through school and so forth? What are their needs, okay, which can help advise you as to how much risk they could potentially take. If they're in a great situation financially, the money's coming through the transom, the bonuses seem to be better and better, they've already got fancy 529s for their kids, they're not worried about kids' education, then I think you can be more aggressive with them in terms of that basic allocation. If, on the other hand, it's the reverse, you got to analytically be more conservative. But there's another component, Frank, and that's the psychological portion. We all know people who are rich as Croesus, but if they lose a penny, they can't sleep at night, right? I'm exaggerating, but the people are on the other end of the spectrum. They open the market and see Trump did this, or this happened in the geopolitical sphere of things. What does that mean for the economy and my investments? And just go into a frenzy. One needs to respect that. because the last thing you want is to construct a beautiful portfolio for them analytically to take them where they want to go, and the next day they call you up and say, I had a sleepless night. I'm just worried what he's going to do or she's going to do or what they're going to do. Let's sell the whole portfolio. So one needs to recognize that and not let the perfect get in the way of the good. I would also analogize it to, let's say, dieting, right? So you might say, well, in order to get this weight loss over the next 6 months, you need to reduce your caloric intake by this. Someone says, well, hold it. I could get there in half the time if instead of 1,800 calories a day, I was down to 900 calories. So what am I missing here? I said, well, what you're missing is you're going to be so starved by the weekend that you're going to say, I got to pig out here. And pretty soon on Monday morning, there's not going to be any plan at all. You're back to where you were. So we like to take a more moderate take on risk and have more moderate goals if, in fact, psychologically, that client is best suited for a more moderate take on exposure.
It's a good analogy. When investing, do you take into account so-called ESG, environmental, social, and governance issues? So, I let my clients dictate that a little bit. I mean, we're basically, from an analytical point of view, you're looking at maximizing your revenues, your profits for each dollar laid out. And as long as it's a legal and lawful enterprise, I think that's what you want to look at. To say, well, I'll take half the size dividend or pay twice as much because although they're not making as much money, they're more aligned with my view of the world in terms of who they're promoting and things like that, or their take on climate change and stuff like that. Now, at the end of the day, the client's the boss, and you can have a heart-to-heart, say, I'm not interested in squeezing the last buck out of my portfolio. To the extent that I feel better about the portfolio, I'll go in that direction. I think that's valid and so forth. What we have seen recently is, and maybe it's a sign of the times with the recent political developments, there's less interest in ESG by investors than there was. The other thing to watch for, some people say, well, I look at the ESG indexes and they've actually outperformed the S&P 500, so I can have my cake and eat it too. I can do good and make more money. The problem with that is many of the companies, some of the growth companies that were most in tune with ESG principles have not done as well recently. And indeed, as we've seen other groups of the market arise, they're starting to trail the major market indices. And now people are saying, well, I thought it was a good idea, but, I think I'd rather at least make sure I'm doing as well as the market and so forth. So there's a little bit less interest in that. And of course, many companies, it's so hard to define what ESG is. So, your prototype there is Tesla. Now, is Tesla something an ESG investor wants in their portfolio? Yes, to the extent that they make EVs, which are going to be better for the environment than internal combustion engines. No, if you're worried about, the type of person that Elon Musk is and how he's treated employees and his views of the world, taking a bulldozer through government expenditures and stuff like that. So that's another thing to watch for. It's hard to define these various investments and easily put them into the various cubby holes. How do you feel on the equity side about individual stocks, individual equity securities versus funds, whether they're index or managed funds versus individual stocks? Obviously, one has more risk than the other, I think.
The most important thing is to look at your asset classes, whether it's stocks or stock funds, and treat them as risk assets, and then have a portion of your portfolio, whether it's bond funds or individual bonds, as non-risk assets, and not confuse a stock fund with an individual bond and say because it's a fund it's going to be less exposure to risk than an individual bond. So that's probably job one. After that, I would say job one is diversification. Now, if you're able to one of the key attributes of a fund is your money is diversified over a number of different investments and so forth. Now, if you have a small amount to work with, you can't do that on your own. If you're investing $10,000, you can't invest in 100 companies, while you could buy a fund that has more than 100 companies and with $10,000 get instant diversification. So a little bit depends on the size of the nest egg you're working with, but diversification is always job one. Once you get to the point where you could perhaps devise a well-diversified portfolio using individual stocks, there are a lot of good reasons to do that. I think one of the most important reasons is getting control of your taxes, okay? So if you're investing in a tax-sheltered account like an IRA or 401k, great for you. But many people are, of course, investing in taxable accounts. And so every time you trade the stock, you are going to have a taxable event. And if you have, certainly with an actively managed mutual fund, they're looking at the gross return, not the after-tax return. And so some of their investors indeed are coming in through tax-sheltered accounts like 401ks. They don't care about after-tax returns. They just want to maximize gross return. If you're in a taxable account, you want to be more sensitive to the tax implications of turnover. That's a good reason to hold those stocks individually. Of course, fees is another component. Your own portfolio charges even less than an index fund because there is no charge over this overlaid on that. And for the most part, of course, commissions are zero in the investment world today. So, I think for bigger portfolios, which are tax sensitive, the nod may go towards having good exposure to individual stocks. Smaller portfolios, in those that are in tax sheltered accounts, you might want to give the nod to funds.
So with an individual stock, how do you decide when to cut your losses or take your gains?
Yeah. Well, I'm probably not as extreme as Warren Buffett, arguably one of the most successful investors ever, who said your holding period should be your lifetime. But I do think that one should be wary of excessive turnover. Remember, every time you buy or sell a stock, it's a bit of a crapshoot, because what you're saying is if you're selling a stock, well, who are you going to sell it to? Someone else on Wall Street. And to what extent do you know something that they don't know? One needs to be humble in this business and assume, particularly if you're a subscriber to the efficient market hypothesis, that all information is known. So you really can't get an edge by trading, because all the warts that you perceive are already perceived by the other side, and the price now reflects the warts or the lack of warts that makes it a high price. So I could make a great case. And indeed, one of the virtues of index funds, one of the reasons they've outperformed actively managed mutual funds, is very hard to get an edge on the market using publicly traded stocks. So I would say, as a general proposition, you ride it up and down. Having said that, I do try and time the transactions I do make. I'm looking for where the valuations look unusually attractive, price to earnings, price to sales, dividends, relative to the market, relative to the peers in that industry, relative to the company's history. And you're also looking for that other factor, which is hard to put a number on, but is important psychologically. So, for example, today, people are, President Trump's talking about putting a ban or a prohibition on cooking oil coming to the country. And now people are bidding up some companies like Archer Daniel Midlands, who are in the cooking oil business. Well, great if you already own it, but I wouldn't use that. I wouldn't buy it today after you've had that nice kick from President Trump, because as we know, what is said today by the administration may not be true a week from now, and you're kind of locking yourself into buying on good news. While conversely, if the stocks came down because you said, we'll never have a tax on cooking oil, I just had a nice conversation with Premier Xi, maybe I would buy it on that thing. So it's a psychological thing. Basically, you want to buy low, you want to sell high. What is low and what is high is a real art, but you like to say that after spending many, many years on it, you kind of know it when you see it, although you're never absolutely sure.
That's a great note to wind up on. Buy low, sell high. David, thanks so much for joining me here today. Lots of good advice, good information, and thank you very much for being here.
Frank, thank you so much for having me back here. It's always a pleasure to talk with you.